Good morning. It's Jeffrey Christian of CPM Group. It's about 10:54 here in New York on the morning of Tuesday, April 1st. I wanted to talk today about what's driving gold and silver price increases. We want to focus on the real market, not the imaginary one. And so that's what we're going to do. I'm going to take a short-term and a long-term view because what we're seeing are long-term problems that have existed since the World War II and have gotten worse. They took a turn for the worse in the early 1980s, economically and politically. They got worse again after the year 2000. And these long-term problems are becoming shorter-term realities. As I explained it to someone over the weekend, I've spent my life worrying about certain things developing. Now that they're actually developing and emerging, I find myself more calm about them because I can see where we're going and I can better judge how to protect myself and my family from the things that I've worried about all of my life. There are increased uncertainties. There are increased risks, real risks, economically, politically, socially, technologically. And these risks are becoming more apparent to more people with increased uncertainty and increased anxiety. That's bringing along gold and silver prices. There are three big areas to pay attention to, maybe four. I almost added a fourth one. The first one is international political shocks. And it's not just international politics, but also domestic politics. International politics are, to some extent, an extension of domestic politics. The U.S. is no longer the hegemon. It is we've always argued that it really wasn't there to uphold the goodness and help mankind, although it did do a lot of good in the post-war period, but it was upholding the global political status quo and leading it to reforms. It's now leading toward destruction and obsolescence. There's a rise of authoritarianism, not just in the United States, but around the world. And the weakening of the U.S. hegemon and the weakening of U.S. political power has opened up the doors for governments and leaders to become more authoritarian around the world. That's a bad political development. There's also a breakdown of the systems and the rule of law. There's deglobalization. We're moving away from economic unity and cooperation toward competition. And this is something that goes back in the Republican Party as far back as the Reagan era. But, George W. Bush ran on a platform that included, in the year 2000, included the idea of abrogating all multilateral international agreements and only dealing with countries on a bilateral basis. And the view was that that would give the U.S. greater bargaining power, or as Mr. Trump has shown, the ability to extort compliance with the U.S. will with greater effectiveness than multilateral agreements. We've seen since the late 50s and 60s, and it's accelerated and continued ever since then, countries and governments around the world saying, hey, we should rebalance the political power that we invested in international organizations after World War II. World War II was pretty bad for anybody who lived with it. And the aftermath of World War II was not much better. And we had the Cold War. And we created the World Bank and the International Monetary Fund and the United Nations and a host of other organizations to try to get governments to cooperate among each other. And because of the U.S. power imbalance at the time, the U.S. was able to get and encourage, not demand, compliance with these international rules of law. As early as the late 50s, you started seeing other countries saying, hey, maybe we should rebalance this. And the United States and Europe refused to do that all along, which brings us to today. And then there's a third set of factors, which are technological changes. The rise of artificial intelligence, such as it is one of those factors, but probably a much bigger problem are computerized economic activity in general. We went from computer-assisted design to computer-assisted manufacturing. Now we're moving to computerized manufacturing. I have some charts that I was looking to update, and I couldn't find the one, but it pointed out that economic manufacturing output in the United States has actually risen sharply since the 1980s in terms of the dollar output of U.S. manufacturing. But the number of employees has fallen in half. We're making more, despite what politicians say. The United States manufacturing, we've lost more jobs to computers than we have to offshoring. And even with the loss to both computers and offshoring, we have greater manufacturing output today than we did at any point over the last 40 years. It's computerization. There could be a fourth horseman here, which is social changes and social shocks. But I didn't put that in there. You put this all together and you can see that these trends have been developing for 70, 80 years. They've gotten worse over the last 45 years, and we're getting to a critical point. This is our chart of global economic activity, total GDP. The red line is the world. The top blue line are emerging and market economies, and the bottom blue line are advanced economies. The larger economy, the lower the percentage output increase because you're at a higher base. But you can see that for a long period of time, really from the 1980s through until 2020 or so, you had a status where world economic activity was, for the industrialized world, 2%, except when we went into recessions in 1980, 1981, 82, in 1991, in 2001, and then the big one in 2007 to 2009 and 2020. Excluding those recessions, you saw baseline industrialized advanced economies running 2 to 3% real GDP. You saw the world in the 2 to 4% range, and you saw emerging nations with much stronger growth from a much lower base. Our projections are that we will see a recession in the next 24 months, and that when we come out of that recovery, the baseline post-recessionary growth levels will be lower than they have been for the last 45 years. There are economic trends that suggest the world will not do as well over the next 10 years and beyond as it has over the last 25 to 45 years. That creates an environment where investors buy more gold. For most of my career, you can see from 1967 really until 2001, 2002, we would have periods of economic and political problems that would cause investors to buy more gold. And we can define more gold as more than 20 million ounces on a net basis, annual basis, physical gold demand. And you can see 67, 68, 73, 74, 79, 80, 86, 87, 1992, 1997. You'd see 1 or 2 years of bad economic and political developments causing investors to come into the market, buy more gold, and the price would rise. Then things would get better. Investors would buy less than 20 million ounces on a net physical annual basis, and the gold price would decline or move sideways. That changed in 2000, 2001. We didn't really see it show up in gold investment demand until 2002. But since 2002, we have had many years in which investors were buying more gold. More investors, more types of investors were buying more gold at higher prices in more parts of the world than before. That post-war period of 1 or 2 years of economic and political problems followed by things getting better basically ended in 2000, 2001. And we've seen investors around the world buying more gold. There have been a few years, 2013, 2014, 2017, 2018, where investors bought less gold, 2019. But by and large, we've had more investors buying more physical gold since 2002 than they had bought in the 5 or 6 millennia, depending on what part of the world you're from, up to 1966. Anglo-American, which did the seminal big study on the gold market, supply, demand, and above-ground inventories and who owns those inventories in the 1960s. By 1966, when they came out with their report the first time, they estimated that investors had bought about 350 million ounces of gold, that investors held about 350 million ounces of gold around the world. They bought far more than 350 million ounces of gold over the last 25 years, 23 years. And that's what's driven the price higher. And that's what's driving the price higher now. Now, this chart the projections for investment demand goes through 2025. The estimates go through 2024. We project for 2025. And you can see we have about 36.6 million ounces of gold net physical investment demand for gold in 2025 and 2024, and about 39 million ounces, 39.6 million ounces in 2025. So we're up there among the top 7 years in terms of volumes of net purchases by investors last year and this year. And we saw 32% increase in the price of gold last year. We expect a significant increase in the price of gold this year. Why are investors buying gold? For all of those economic and political and social and technological reasons I just mentioned. This is from our gold yearbook, which we released last year. I'll tell you how you can buy it later. These are CPM Group's, mine. It really started in 1980 when I was at J. Aron. In December of 1980, when I started at J. Aron, they said, would you buy or sell gold? And I said, I would sell gold at today's price. And then I changed that attitude opinion in 1982. End of 1982, I issued a sell recommendation, and we went back and forth along with those bars of investment demand. In 2000, in November 2000, when the price was $293 an ounce, we issued what was then our gold survey, and we said that we thought that the economic and political environment going forward would be much more hostile for decades to come than it had been in 1979 and 1980. And in 1979, 1980, you had a spike up in investment demand right here. And you saw the gold price go from about $190 an ounce to $850 an ounce on an intraday basis, and then come back off. Averaged about $612 a year on an annual basis in 1980, if I remember correctly. You had 2 years and it was wrong. But in the year 2000, in November 2000, we said we think the economic and political environment is going to be much more hostile than it was in 79, 80. and the gold price would blast right past $850 on an intraday basis and move to record highs because we said there was an upward shift in the investment demand curve. More investors in more parts of the world would be buying more gold for a longer period of time at higher prices than they had ever done before in the history of mankind. That's what we projected, and that's what's happened. And that drove the gold price higher. We reached a peak around 1600 on a monthly average basis in 2011. It came back off. We issued a buy recommendation around 2014 when the price was 1200. We were a little bit wrong, or we were a little early in terms of issuing a buy recommendation. The price moved sideways into the second half of 2019. And since the second half of 2019, you've seen the price go from about $1,200 to today. The price is $1,360 as I speak for the active June COMEX contract. So that's what's happening. You have a long-term issues, long-term problems coming home to roost at the exact same time when political leaders in the United States and around the world have a reduced capacity to deal with those problems. Now, I have a couple charts, a chart and a table here on central bank gold demand, because you keep hearing that the gold price has risen based on central bank buying. And central bank buying has definitely been important to the price of gold really since 2008. You can see that central banks were big net buyers prior to 1965. They sold gold from 1965 to 1967 into 2007 on a net total basis as a group. And a lot of that was from 1989 to 2000. And a lot of that was central banks in Europe, which had 80, 90, 95, 97% of their monetary reserves in gold. They needed dollars to defend their currencies. So there was a consistent selling of gold from 1989 to 1998 through 1998 by countries that were opting into the euro. Switzerland and the United Kingdom, which were not opting into the European Central Banking System and the euro, stood aside until 1999. In 1999, the Bank of England and the Swiss National Bank both announced that they were going to be selling gold publicly for about 5 or 6 years to reduce their holdings. Switzerland had about 86 million ounces of gold in 1999, and they wanted to sell half of it and get down to about 43 million ounces, which they did over about 6 or 7 years. The Bank of England had about 20 million ounces, and they wanted to sell half of it, about 10 million ounces, over 5 years through public auctions. They wanted to increase the transparency. And by the way, one of the interesting footnotes that you will not find in your history books is that the decision to reduce the Bank of England's gold holdings by that much was actually made in the late 80s, early 90s, long before Gordon Brown was the Chancellor of the Exchequer. Gordon Brown fell on the sword and took the blame for the sales that occurred while he was there. But the plan to sell that gold actually was hatched and developed in the late 80s, early 90s. And then the Bank of England, because central bankers were much more gentlemanly back then, said, okay, all of these banks going into the euro and the ECB need to make their modifications on their monetary reserves before January 1st, 1999. So we will stand aside and we will not sell our gold until 1999. And the Swiss National Bank said, we also will stand aside because we're not going into the euro. But Gordon Brown has taken a lot of blame for something that was decided really a decade before he was there. But that's all history. That's just an historical anecdote. The reality is that by 2007, most of the central banks that wanted to sell some of their gold, or all of their gold in a couple instances, had sold the gold they wanted to sell. So you saw a sharp reduction in gross sales by central banks, mostly in Europe and the developing world. And you saw an increase in purchases by central banks that had not accumulated gold back in the 50s, but had become major trading countries and had 70, 80, 90% of their monetary reserves in the dollar. And they wanted to have a diversified base. So they started buying other currencies. The euro was available at that time. And there was hope on the part of some people that the euro would develop a liquidity to be complementary with the US dollar as a de facto reserve currency. Hasn't quite happened, although it is the second most liquid currency around. Those central banks that had most of their reserves in dollars started diversifying into other currencies and were buying gold. And on average, they bought about 10 million ounces of gold, a little bit more than that, every year since about 2008. They bought about 14 million ounces in 2023, and they bought about 8.54 million ounces in 2024. So central banks are still buying gold. They're still an important source of demand for gold, but they're not the big driver. These are the data for 83 and 84. I showed you this last week. 13.9 million ounces of net official gold purchases in 2023, 8.4 million ounces last year, off 40%. Right? Central banks buy gold based on the dollar value of the gold, but they bought 25, 26% less gold in value last year than they had in 2023. Central banks are important. 8.4 million ounces in a 130 million ounce market is a lot of gold, but it's not 36.6 million ounces like private investor buying was. Central banks are part of the equation, but they are a smaller portion of net changes in stock demand, the demand for gold to be held as gold in bullion form, coins or bullion bars. They're not as dynamic nor as large as investment demand. It's really investment demand that's been driving investment demand, the prices of gold higher. Similar situation with silver. Although with silver, investors are much more inclined to sell silver when they don't think the price is going to rise. But we've seen some investors buying net amounts of silver since about 2005, 2006. There are no deficits if you do your math correctly in the silver market. The silver market is not being driven by fabricators scrounging around looking for metal. There's plenty of metal to meet fabrication demand. The price has risen explicitly because investors have been buying silver. And because investors do not use silver, they keep it in silver bullion form, it should not be counted in your supply-demand balance. Total supply less fabrication demand equals your surplus or your deficit. And we have had surpluses for 20 years now. The surpluses got very small in 2021 to 2023, down to about 50 million ounces and 70 million ounces. And then last year, they got over 150 million ounces. We're doing our projections now for this year as well as the next 10 years. And we see a sharp increase in investors' demand for silver, which is fundamentally behind our expectation that we will see silver prices rise strongly again this year on an annual average basis compared to last year. And there is plenty of silver above ground in silver bars and coin inventories available to the market at the right price. Most of this is held by investors. You can see more than 2 billion ounces in coin form, mostly held by investors. Another billion ounces in ETFs, mostly held by investors. And then the yellow part are the implied unreported inventories based on supply and demand data going back past 1950. And some of that is held by banks and trading companies that lease it out to commercial entities, mining companies, smelters, refiners, fabricators, wholesalers, retailers, who do not want to tie up their capital with their working inventories. So they lease the metal in from banks and trading companies. And as they sell their product, they buy the silver that's contained in that product. That's why banks and trading companies own a few 100 million ounces of physical silver, which they hedge with short positions on the COMEX. And the banks that lend them the money to finance their trading operations say, we'll lend you trading operations, but given the price volatility of silver and gold and other commodities that you're holding in inventories and leasing out, you go home every night hedged. But some people don't want to believe that because they're sick. These are our price projections, intermediate term price projection since 1980. And again, you can see prior to 2001 or so, we were back and forth. In 2001, we said buy silver. We were a little bit early. 4 or 5 years later, the price started rising. It got up to very high levels in 2011. We said, this is the time to sell. That was actually April of 2011, because we were looking at what was going on in the May COMEX silver contract, which had large open interest, which was driving the price higher. The price of silver at the beginning of April 2011 was about $35 an ounce, which was already very high. And then it went to $50 an ounce over the course of April as the COMEX May contract rolled into July. By the beginning of May, that open interest had declined from around 350 million ounces down to virtually nothing. And the price of silver fell in the first week of May to $32 an ounce. We have about 600 million ounces in May open interest at present on the COMEX. So April is going to be an interesting month for silver. But the silver price on a longer term basis fell from 2011 into 2019. We issued a buy recommendation around the middle of 2019, and the price was about $13, $14 an ounce. Today, right now, the price of silver is $34.60 for the May COMEX contract. That's off about 1.6 cents from yesterday's close. I've gone through our price expectations to some extent. Gold prices are at record levels this week, $3,160. It's not surprising given the economic and political uncertainties and anxieties that you're seeing on a global basis. Our expectation is that the price will probably stay strong in April. We might see the price come off for a few months after that, but we don't see it coming down sharply. Just sort of a pullback. We don't see the problems going away, so we don't see the investment demand diminishing sharply. We think that if the price falls back to 3,000 or even 2,800 or even 2,600, you'll see a lot of investors taking that as a buying opportunity. That's what we're recommending people to do. So we still think that the price will move to new highs this year. We could see a period of plateauing, temporary pause in the increase, but we still see the fundamental economic factors driving investment demand, continuing to drive investment demand higher, pushing gold prices higher. Very similar situation in silver. Silver prices have not risen quite as much as gold. That's primarily because investors around the world tend to think more toward gold than silver as a safe haven and an alternative investment and a portfolio diversifier. But a lot of investors do think about silver too. So you are seeing some strong demand, and we expect that strong demand to continue. And we are projecting record silver prices over the next couple of years before perhaps the world gets a little bit better. We issued our gold yearbook last week. You may go to our website and buy it. I have bought. The last page tells you if you want to print the book, here are the print specifications. You can take the ebook to a copy shop. I do that, so I have a copy of it printed out every year, so I can dog ear it and refer to it over the course of the year. You may go to our website and buy it and download the ebook. It's $160 US. We will be coming out with our silver yearbook in May, late May, 27th of May, and our platinum group metals yearbook in late July. We also have a retail investor program, which takes some of our research and makes it available at a lower price point compared to some of our more expensive work that is used by commercial companies, mining companies, smelters, refiners, fabricators, central banks, governments, institutional investors. You can read about that at our website. You can go to our website and download free reads and videos. You may pre-order the silver and platinum yearbooks. You can subscribe to other services. You can read about the retail investment program, and you can buy last week's gold yearbook. That's all I have for now. Take care of yourself. Take care of those around you. Be good to the world, and we'll talk to you later in the week.